Hello, everyone, and thank you for joining us for week one of our four-part summer webinar series here at BFSG. This week, a topic that was hotly requested over last year, 2024's summer and fall series, long-term care insurance. With me today, I have Paul Horn and Brian MacArthur, who I know all of you are familiar with. Brian's been here talking Medicare with us over the last several years, and Paul's our Director of Financial Planning.
Thanks, everyone, for joining us today. Thanks, Chad. Again, my name is Paul Horn. I'm the Director of Financial Planning here with BFSG. Lead a team of about 8 other CFPs doing financial planning. One of the topics that we obviously cover a lot here is long-term care planning. With me today to discuss this is Brian MacArthur. He is a good friend of mine, and most of the knowledge that I have has come from him on this topic. So, Brian, I'll just introduce yourself a little bit further.
No, thank you, Paul and Chad, and thanks for having me again. It's always great collaborating with you guys at BFSG. My only claim to fame, if this is one, and there's no trophy for this, I checked, but I often tell people they'll probably never meet anybody who's met more financial advisors than I have, so I get a large sample set of experiences to really observe great people and great practices, you guys are about as good as they come, and I say that sincerely. I've met thousands of financial advisors and work closely with hundreds, so I only say that if I mean it. My name is Brian MacArthur. I am the CEO of DesignMyMedicare.com. We spend most of our time guiding clients of astute financial advisory firms through Medicare, basically turning complicated topics into something simpler, and trying to get a good to great result for the client under the watchful eye of their financial advisor at firms like BFSG. My prior career also touched largely on long-term care planning. As you can imagine, Medicare and long-term care in a lot of ways kind of sit on a shelf right next to one another in most of our heads. Obviously, they're both kind of health-related concerns, and it's not uncommon that long-term care planning discussions arise as a result of guiding people through Medicare. In general, what I'd say about long-term care planning is it's we're going to go through some stats. They're relevant stats. They're real stats. The best stats are not nearly as helpful as, honestly, your own family experience. We just find that as we go through this, most people, if you're 55 and older, I'll put it this way. If you're 55 and older, you're only on this earth because of two 80-year-olds. And of course, if you're married as a couple, you're on this earth because of four 80-year-olds. And if one of those 80-year-olds got sick, got better, got sick, didn't get better, or needs care now, you get it way more than any statistic can drive home. So we'll kind of cover these topics. I'm just happy to be here with Chad and Paul and the BFSG crew.
Perfect. Let's jump right into it. Brian, why don't you start telling us about just kind of what is long-term care? How's it defined? How do you look at it?
Yeah, so this is a technical term. Long-term care planning is not for sissies. Okay. So to my earlier point, it really is something worth planning for. If you've had a family experience, you kind of already get that. But in general, what I think is important to realize about long-term care planning is obviously it can arise and often arises as a result of some medical condition, but it might not. It could just be, you're generally healthy and then you wind up being unable to perform certain activities that just feel pretty normal that you don't even think about right now. So, the chances that there's just a high probability that any or all of us will wind up needing some type of care at some point, but really driving into what's long-term care. The long-term care insurance industry really looks at 6 activities of daily living, and then they also look at cognitive impairments. But starting with the physical impairments, basically the long-term care planning industry is basically looking at 6 activities of daily living. So number one, they're measuring things like, can you feed yourself? Can you bathe yourself? Can you dress yourself? Can you transfer yourself? Transferring would be, can you get into a chair from a bed? Can you get into a bed from a chair without assistance? That would be transferring. And then can you make an unassisted trip to little boys or little girls' room, and just everything that involves in that, walking, sitting,
Yeah.
performing, if you will, cleaning up, standing up, that sort of thing. So that would be toileting. And then separate from toileting is continence, So really what the way long-term care planning works, or what the insurers are looking for, is if you have an inability to perform any 2 out of these 6 activities of daily living. So any 2 out of those 6, for whatever reason, would trigger a long-term care claim. And when I say trigger long-term care claim, that means your long-term care policy that you've been paying premiums into now is in a position to have to start reimbursing you for your care. The
Yeah.
one way, go ahead.
I would say, like, I just kind of think this is Maslow's hierarchy of needs, right? Like, these are the most basic needs every human has, right? We've got to eat, be able to use the bathroom, be able to move, be able to dress ourselves, just the basic things day to day take of ourselves. When you're losing the ability to meet those, or a loved one is losing the ability to meet those basic daily living functions, the most basic of needs, that's when care is really needed at that point, more above than anything else. Now, care might be needed before this, especially if it was due to, mental capacity issues. But when I have clients that start talking about a loved one struggling with any one of these, this is where I really get into the planning and understanding what their needs are and what the care should look like for that loved one.
Yeah,
Hey,
no,
guys,
well said.
before you really dive into it, because I think a lot of this is about like what people can expect from costs and all that fun stuff. Just because this is a question that already has a bunch of thumbs up, is there anything that you guys plan on talking about as we go through the slides that this recent legislation has impacted? And I know there was a hand that was just raised. For compliance purposes, we cannot unmute lines. Please do type your questions in, and we'll address them. But is there anything on if a new legislation is going to impact anything you talk about today?
I honestly, with the new legislation, there's nothing there to discuss yet, unless I'm missing something, Brian. It's over 200 pages, and I'm still threading through that thing myself. So, we can touch on that if anything comes up, but nothing that I'm aware of yet on that.
Yeah, and what I'd say is that obviously legislation touches different things, Medicaid, maybe Medicare. Long-term care planning is largely on you. So I think one of the things that people typically find valuable out of these discussions is really drawing a line in the sand to really let you know, and we'll go into it, but that, Medicare, as wonderful as Medicare will almost certainly be the best health insurance you've ever had. That is not a long-term care plan. And we'll kind of go into that. There's a little bit of overlap of what you could kind of call long-term care in finite situations of what Medicare would cover. But largely what you're thinking about, just helping you with these 6 activities of daily living, or managing a severe cognitive impairment, Medicare is not going to do anything there. Long-term care, you're kind of on your own. I'm not into, fear tactics or anything like that, but this really is a responsibility that really rests on your shoulders, and to some degree, sometimes too much of a degree, to your loved ones. And of course, if there's any friction in just dumping this responsibility on your loved ones, that's kind of often where long-term care insurance might come into play. But as far as current legislation, I wouldn't anticipate that when Paul gets to page 200, that I don't think he'll have anything different to report. This long-term care discussion is really separate from Medicare, separate from Medicaid, separate from health insurance.
Yeah.
Thanks, gentlemen.
Yeah.
All right. So the question I get a lot is, why should I even be planning for long-term care plans? If something happens, then, just kind of let it happen. Like anything else in life, if we don't have a plan, then we're planning to fail. That's just kind of it. You either get out in front of a potential problem, or you try and deal with the problem when it comes. And a lot of times your options are severely limited because you're not able to plan for it, obviously. Now, when we look at the probability of needing treatment or some sort of help with long-term care planning. What we see here is guys are potentially going to need it. 64% of men will need any type of care. Women, 75%. 3 out of 4 females are probably going to need some sort of care during their lifetime. It's not because they're more fragile, it's the opposite. It's because they're not as dumb as guys, so they live longer. And because they live longer, they're more likely to need the care. So, if you are a female, you definitely should be thinking about it. If you are a married couple, you definitely should be thinking of it. About 70% of all people 65 or older will need some form of care, whether it's family or friends, paid in-home health care, maybe using a nursing home, and for a few, that could mean assisted living. The cost of care can be a little bit expensive. So looking here, just kind of highlighting the most expensive states, you might think California is number one on that list or New York's number one on that list. Actually kind of surprises me, but it's Maine, Alaska, Delaware, Minnesota, Montana, Washington, not states that I would expect the cost to be this high. When we look at the least expensive states, not as surprising, but it is interesting to me how you can have Arizona, California at $35 an hour for in-home hourly cost, but Nevada is the cheapest at 28. So this is really a state-by-state issue. So depending on the state you live in, the planning for care might be more important, especially if you're trying to do in-home care, which tends to be, for many, the most expensive option or one of the most expensive options.
And also the most preferred option. I mean, as and we'll cover this in later slides, but it really doesn't matter how nice the closest long-term care facility is to your home, and if they have an ocean view or whatever. Everybody wants to be at home as long as they can. So home care, I can tell you what I've observed in the long-term care industry on the claim size. 80% of the long-term care claims of people who own insurance and say, okay, I think I'm now eligible for benefits. 80% of these events start off at home. They may not last at home forever, but home care is the overwhelming priority. And we don't need to take a poll on that. I'm sure everybody would agree. The transition into a facility, as nice as that facility may be, is usually a distant second preference to being in your own home.
Yeah, and I did have I did misspeak. I said Nevada was the cheapest. I misspoke there. It's actually Louisiana is technically the cheapest. I just meant it's surprising to me that Nevada's in the cheapest 10 states and Arizona and California are in the highest 10 states. So thank you for holding me
accountable. Yeah, that's curious. I mean, there's probably just some basic supply and demand or, thing going on there as far as whatever the pool of talent is or is not in those areas. It's interesting.
Yeah, just some interesting stats. So like anything else in life, it's not simple. Long-term care planning is nuanced, like just about anything else in life. And it is important to understand these sort of variables because they impact the planning that should be done. Okay. So this is looking at if someone does need long-term care, what is the length of time that they need that care? Women, 33% of the time, it's less than 3 years. But 3 out of 5 times, 41%, you're looking at care needing in excess of 5 years. Now, the median, the average length of care is about 3 to 5 years. This is where most people kind of fall in. That's just with the averages here.
Yeah, and I think, there's a couple different things going on here. Of course, the amount of time you need care and also the cost of the care. And I think some future slides will kind of discuss that. But I think for a lot of you who, have prioritized saving and, being good savers, there's very few events that could put a lot of income producing or withdrawal pressure on your portfolio more than a long-term care event. And I think that's kind of why we have insurance, right? Like, insurance isn't free. You have to pay monthly premiums for it. But what's the benefit of that? Well, it's there to smooth out the cash flow so that, if you don't like big surprise 4 and 5 and maybe 6-figure bills, then that's kind of what insurance is there for in all cases. But if we look down towards the bottom, I mean, it can easily run, let's just call it $250,000 per event. And a lot of you, if you have those assets, you're happy to do it. If not, then a lot of that responsibility falls on family members. I don't think this is a binary discussion, Paul. I think even people with very robust long-term care uh, uh, insurance policies will, their loved ones will still be in a position to oversee their care, but there's a big difference between overseeing it and, being the primary caregiver. And, bottom line is these events are long, they're expensive, and, they're kind of worth planning for if you can.
Yeah. So, Brian, do you want to talk about how long-term care planning isn't just about for the individual, but how it impacts other family members as well?
Yeah, I think this is probably the most important conversation to have as early as possible. The One of the conversations, like, I'm going to engage in some broad, maybe unfair gender generalizations here, and we'll see if I, if I make it to the end without consequence. But um, the there's times I've had these conversations with couples, and women tend to be a bit more predisposed towards planning for these events. Not to say men don't, but if somebody's going to say, "Oh, I'll never need this. I'll just go to the backyard and put a bullet in my head," or something, I hate to be crass, but like those are things that guys say, right? And there's in reality, people don't do that, right? It's not a conversation everybody wants to have, but just like other things like life insurance, you don't want to focus on dying, but once you get the life insurance, you don't need to even talk about dying, right? Because you're prepared for it. So long-term care is kind of similar. But the bottom line is, look, if you don't have a plan, and I would never villainize self-insuring or having a family member be your primary caregiver. But my question is, like, does that family member know that you think they're going to be your caregiver, right? And a lot of times that responsibility falls on a spouse who, of course, is willing and able to do it, even if there's no notice. But that creates a lot of disruption, right? So, the easiest way a for someone to increase their chances of needing long-term care themselves is often to be a spousal primary caregiver, because who the heck is going to take care of you better than a spouse? But there's so many opportunities for people to get hurt or pull out their back or run themselves ragged, that primary caregivers, if they're spouses, often wind up needing long-term care themselves. And I think if you look at the things that you appreciate about your loved ones, primarily your spouse, if you have one, and then by extension, other loved ones, is, how much a long-term care event is going to disrupt everybody's life in some way, but do you want it to be irreparably disruptive, or do you want to have a plan that puts loved ones in a position to oversee your care, which is a much different responsibility and less risky to them and more sustainable than having your loved ones be your primary care taker. So it's just a conversation worth having and planning for. A lot of people don't, because honestly, if you never talk about it, you're probably still going to take care of your loved one. But the results of unplanned events, while families get through them, it's just very disruptive, and you know
It, it's it's tough enough watching a loved one go through this process. I can speak from experience here. My mother-in-law passed away at 66 2 years ago due to dementia, early onset dementia, and we went through this whole process with her. My father-in-law did provide the care as long as he could. Got to the point where she was not meeting 3 of those ADLs. He's older. He just couldn't, hurt him. He hurt his back trying to help her bathe and her take care of herself. And so that's where, as kids, we had to step in and we brought in home health care aides to help him at least during the day to keep her comfortable until it got to where we did have to put her in assisted living. It's not a fun conversation or a fun thing to watch. And it's even harder when it's not planned for and it creates additional stress on the family. So I do recommend having these conversations ahead of time. Find out which of your kids might want to take care of you or might not. I've had clients that thought their daughter who lived down the street was going to just step in and take care of them if needed. Nope. It was the son that moved back from Texas, came back to California to be closer to his family, and him and his wife took care of the kids. Actually, took care of the parents along with their kids because the sister wanted nothing to do with it. It was too emotionally difficult for her. So she wasn't trying to be selfish or callous, just the emotional implications of it, she just wasn't prepared to handle. So
Right.
if you are older, have these conversations. If you are younger, if you have parents that are aging, that are getting up there and beginning to have to consider these sort of things, initiate the conversation with them from your end and from your perspective, and let them know what you're willing to and to not do to try and help get out in front of this before something's actually needed.
Yeah, it's way easier, I think, to have a conversation when the event's not happening. All right. And if there is any friction or discomfort, I would still just do it. And you can laugh about it if you're talking about an event that hasn't happened yet. But just talk in reality of like, who would care for, um, for a loved one, and to just have a plan in place. To your earlier point, Paul, um, in general, I'm gonna say that for people who and I wouldn't villainize not having long-term care insurance. I think self-insuring, if you have the assets, is definitely a plan. But people who don't have insurance, even if they have a lot of assets, it's very unlikely that the family or primary caregiver pulls the trigger to hire care as quickly as they should.
Yeah.
Where if you do have insurance in place, and the family members don't have to be an expert of this. They just know there's 2 out of 6 activities of daily living. You'll probably forget 4 of them by the end of this webinar, and that's just fine. But the fact that you know that there's 6 of them, and as you're observing something happening in your family, you kind of know, like, okay, well, if we have this insurance, why wouldn't we be using it the moment that we're eligible for it? So the one thing about insurance, which is not the only way to plan for this, is that as soon as you or your loved one is eligible to start reaching into the insurance company's pockets, the family's going to do that. There's no reason to delay, and it's actually an easier conversation because 1, you talked about it. 2, you probably invested the money in the insurance, and 3, why would anybody want to make it easy on an insurance company if you can get money out of their pocket and then you would do that. But the amount of times that primary caregivers continue beyond what is reasonable to provide care because there is no insurance, like that's just the predisposition, and some of it's frugality and some of it's just love and responsibility. But I'd say, when insurance is appropriate and available to you, it just makes it easier to pull that trigger when it's just, when any family member says it's time.
Yeah. Absolutely. So what does planning do for us? Number one, it just provides peace of mind, right? 87% of all Americans that have been surveyed think having a long-term care plan would help them feel more confident about their financial future. Just knowing that you can handle it goes a big way. And when we look at, as a financial planner, when I'm looking at long-term care needs for my clients, there's really 2 questions that I'm trying to ask. If a long-term care event happens, can the client afford to pay for it? Yes or no? If they can't afford to pay for a potential long-term care event, they need some form of insurance to be able to cover that. Now, if they do have enough money to self-insure, I ask another question. do they want to pay the bill if something happens with long-term care? Or would they rather save their money and have an insurance company pay for the bill? If they'd rather have the insurance company pay for the bill, then we still look at long-term care at that point. Now, a lot of people do self-insure and they do have enough funds and they are comfortable with that. And that's more than fine. They are willing to carry the risks and understand the conversation. And things can change too along the way. I've had people where we started on the self-insured path and a few years later, just they watch a family member, a friend, someone else that they know go through it. And that kind of spurs them to want to look at insurance to do that. And when we talk about insurance needs, it's not an all or nothing. You don't have to get this Cadillac policy that's going to make sure that you're covered for the most expensive treatment facilities in the country. You don't have to pay for Cadillac services. For some clients, it is a combination of both. Having a smaller long-term care policy that can help defray some of the costs if something happens, while they still also have enough assets to self-insure. And so a mixture of the two for most of my clients is what I find they prefer to do if they have any form of long-term care insurance.
Hey guys, just because it's so relevant to, I think, what something Paul just said, and it is heavily thumbs up. Does long-term care protection, does the package need to be purchased before someone loses some of these abilities? Or I think, like you just said, like, man, you're starting to watch it happen. At what point do you need to have purchased it for it to not be cost prohibitive?
Yeah. So before that, just like nobody's going to provide you collision insurance the day after the collision, this is something you really need to plan on ahead of time. In general, and Paul might, look at this similarly or differently. I would say as early as age 50 is probably appropriate to start discussing it. 50 is okay, 55 is okay. There are ways to mitigate this risk with a reasonably abundant amount of options up through probably age 70, and there's still options beyond age 70, but as you can imagine, the options are more limited. The other thing to keep in mind is that the average age that people file a long-term care claim, in general, I used to say age 80. I think one of the slides that we have here says age 76. Again, that's just kind of the average. Some people are before, some people are after. But the bottom line is, why would you? There's a couple reasons to address it earlier. Is, of course, the earlier in life, the less of a chance that you have any issues with these activities of daily living, the less of a chance that you have a severe cognitive impairment, right? So, of course, I'm sure that makes sense. The other thing to keep in mind is that if an insurance company is going to take the risk on covering, the majority of the costs of your long-term care expenses, well, gosh, if you're applying for this and could get approved at age 72 versus 62, if the average age people file a claim is age 76 and you're applying at 72, you're only giving the insurance company 4 years to allow you to pay premiums for them to take on the risk. So the cost of long-term care insurance becomes precipitously more expensive. I don't know if precipitously was the right word there, but the later you apply. So cash outflow wise, it's way easier to address this sooner. If so, I would say 50 to 55. The conversation doesn't always happen at 50 or 55, and that's fine. There's still plenty of room for planning on how to mitigate this risk, in your 60s and 70s. But in general, sooner is not just better because it's easier to qualify for, but it's also easier to fund those insurance premiums. Because let's just say you're paying monthly. The monthly premium is going to be much lower at 55 versus 75 because you're giving the insurance company way more time to kind of collect premiums from you.
It's for the most part, I would say it this way. Okay. And I think this slide kind of ties into what you're saying here, Brian. When we look at lifetime planning for a financial plan, right? Because we're not just planning for now or today, but we're planning for the end of the lifespan for the individual. But here's what we find. The lifespan may go out to 90, but the health span, someone's body, their cognitive abilities, what they're able to do, is often shorter than that. And so this gap here between lifespan and health span is what causes the need for long-term care. Okay. I gave you the story of my mother-in-law. She needed that care starting around 63. She's on the very young end of the curve. No amount of planning other than getting that policy at 50 or 55 really could have prepared the family for that or helped the family. So part of the question when we do this planning for my clients is how much risk do they want to take? Again, it goes back to that, do they need coverage or not based on can they afford it or not? If they can afford it and they want to get the policy, now it just becomes the how much risk they want to take. The sooner they get the policy, the cheaper it's going to be in the short term. They might pay more money over the long term, right? Because let's say the event doesn't happen until 72. You buy the policy at 52, that's 20 years of premiums that you're paying into it. Or if you buy the policy at 68, maybe you're only paying in 4 years of premiums, but at a much higher price. So the question becomes, do you want to carry that risk and get closer to the end of that potential health span, knowing that you are increasing the likelihood that you may not qualify or may get it at very high rates? So that's part of the planning, is running the quotes and just as an individual, what's your appetite for risk in general, right? It's like investments. Some clients are happy to go to Vegas, put all on black, go 100% stocks. Other clients can't sleep if they lose a penny. It's this kind of, that same mentality has kind of applies here as well.
Yeah, and I agree. And the other thing I would say is probably the earlier that you address it, the easier it is to kind of get more benefits. There are some benefits to doing this earlier because there's like inflation riders that'll kind of build it up. So, if you're applying for long-term care insurance at 72, the chances that you're going to be able to afford to insurance to offset 100% of this risk, and I don't think that your goal needs to be to offset 100%. But it's tougher. It's like, hey, what can I qualify for? How much benefits can I get? If you're doing this at 55, it's much easier to spend less amount of money to actually build a more meaningful benefit. The other thing I was going to say on that, Paul, not to get too anecdotal, but but it's almost the opposite situation as what your family went through with your mother-in-law. My kids just wrapped up their freshman year in high school, and while neither of them play football, it's a big part of the school culture to go to the home football games. So last year, my wife and I found that we were going to all the football home games, which was kind of neat. And there was this family that brought their father, presumably the grandfather of one of the football athletes on our team, and they always sat inside. So every time they would arrive, we have to stand up and they shuffle past. It's just that the father or the grandfather is like 94 years old, right? And he would come and, he was there at every single home game. And one of the things I noticed is that as I've thought about this, now this is probably not an unhealthy 94-year-old because the guy's at high school football games, right? But as I really sat and thought about that, I thought, my goodness, when you think of this difference between lifespan and health span, number one, that guy's got to be healthy enough to go to a high school football game, right? And there's a decent walk from the parking lot to the top of the stadium, down the concrete steps, shuffling. And, as he shuffles by, like it's like this human pillow. Everybody's watching him and has their arms out because we just want to cover this guy 360 degrees just in case he loses his footing, right? Because that would be awful. But he's got to be healthy enough to go to that game. Two, mentally, he's got to want to go to the game. Okay. And three, the family's got to want to take him, right? And he's about as healthy as a 94-year-old can get, but it's a little bit extra effort, right? And of course, lovingly, the family was happy to do it. But there's a lot, like all three of those things need to be covered in order for that 94-year-old to show up at a football game. And an inability to perform one of these activities of daily living can, impact that, but it might not need to. I mean, even they didn't have a caregiver, but if you did have a paid caregiver, honestly, it might translate to you going to an extra 8 football games towards the end of your life, which is probably, or as you get older, which is, a big deal. But but there's a lot that goes into even bringing a 94-year-old to a high school football game, right? And most of that responsibility falls on the family. Thankfully, the guy's healthy, but there's so many reasons that 94-year-olds don't go to football games, right? And even that is kind of part of long-term care planning. And I think, I just look at it as kind of that difference between right now, that guy's lifespan and his health span are still the same because he's still getting out the door and doing that. But those events are really, I'm sure really important to that family. And even the benefits of planning show up in something like that. So
Absolutely. So when we talk about planning for long-term care, the question becomes, how do you want to afford it? There are some benefits with Medicare and Medicaid. Do you want to talk a little bit on that real quick, Brian?
yeah, and it's probably easy to just go left to right here. So one Medicare, what I'll tell you is that, like I said, there is a small bit of overlap between long-term care and Medicare, not significant. Medicare, on any Medicare plan, Medicare supplement, Medicare Advantage, basically every plan in the country will cover 100 days of skilled nursing, which is great because skilled nursing's really expensive. It's like a hospital with a lot fewer doctors. It's more for rehabilitation. And most Medicare plans, well, every Medicare plan will really cover the first 100 days. Two things I'd like everybody to think about is number one, if you ever do have an extended or long-term care event, it's going to be longer than 100 days. And number two, skilled nursing is like the last type of care you're going to want, not the first, right? Everybody wants to be at home, right? So you wind up in skilled nursing typically because you're hospitalized for 3 days or more. And they say, oh, well, you're not ready to go home, but you don't need to take up a hospital bed. We need, there's some sort of rehabilitation to happen. And then you go to skilled nursing and you stay at skilled nursing until you totally improve, or you improve and plateau, or, some people are ornery and don't want to do what the rehab people suggest. And if you don't do that, then they say, okay, well, it's time to go home, right? So I don't want to trivialize the skilled nursing benefit because it is, it's important and it's valid, but it's not really what any of us are thinking about right now, right? So again, most people want to be at home. So Medicare, I would not ever consider Medicare to be a long-term care plan. Medicaid, which Medicaid across the country, Medi-Cal in California, same thing. Medicaid or Medi-Cal will and can step in to pay long-term care expenses. You don't need to be entirely broke. You do need to be mostly broke. So typically, your income needs to be below certain thresholds.
Household
Um,
that need to be below 30,000 in the state of California. There is planning that can be done around this. I have helped. My grandmother had Alzheimer's for 12 years. I watched my grandfather spend down everything that he had in retirement to take care of her. Eventually, they were left with, just enough for him to have his care. So we did some planning to get my grandmother on Medicaid so the state would help pay for her services because nobody had the money to pay for it otherwise. I've had
yeah,
another, I've had other clients, for example, that older woman, all she had left was her home. Instead of selling the home to use to pay for the care, with some careful planning ahead of time, we were able to allow her to keep the home and qualify for Medicaid, allowing her kids to still inherit the home. And that was a conscious decision she made while she was before she needed the actual long-term care event happened. We did the planning beforehand. Let's be very clear on that. But since we did the planning beforehand, when the event did happen, and it did, her family was able to inherit her home, but she was able to receive treatment that she needed as well.
yeah, no, that's great insight, Paul. The I will tell you if you ran around to extended care facilities in your neighborhood, you might be surprised at some of the ones in nicer areas still might say we accept Medicaid or Medi-Cal. But here's the thing: you can't really walk in broke with no assets and get one of their Medicaid or Medi-Cal beds. They're unlikely to take you, or at least the places that you might find most desirable might be unlikely to take you. When you hear about facilities that accept Medicaid or Medi-Cal, excuse me, it's more like when you come on in, they want to know how they're going to get paid, right? So you'll disclose your assets and things like that, and then maybe let's say for this is more for a couple or a person who has some savings but maybe wouldn't be consider themselves wealthy, where maybe they have a couple $100,000 in liquid assets, and the place will say, okay, well, that's how we're going to get paid. And then we realize that if they run out of money while they're here, we can move them to a Medicaid or Medi-Cal bed, right? But you don't walk into the nicest place in town without liquid assets and get that Medicaid bed. It's more if you run out of your liquid assets while you're there. That's typically how those nicer places might still get paid by Medicaid. And then you want to talk about number three, Paul, family?
Sure, yeah. So 80% of all home care is done by unpaid caregivers, i.e., typically kids, maybe some grandchildren. We have some clients now that are in their 80s, have grandchildren living with them, helping provide just daily care and just having another adult there that can make sure that they're being taken care of properly. So that is the most common way. Most people don't plan, they just assume this is their plan. And while that might work for some individuals, it certainly doesn't work for everyone. Individuals that do become caregivers, some interesting stats. About 70% of any child that becomes a caregiver for an adult parent, their income is impacted because they have to typically reduce work hours, or sometimes they have to quit work entirely to meet the level of care for their parents. On top of that, if the spouse is the caregiver, for example, my father-in-law supporting my mother-in-law. I've had other clients where the spouse is typically the primary caregiver first. But what happens is when the first spouse dies that needed the long-term care, the surviving spouse, on average, their lifespan is about 2 to 3 years after that event, on average, unless they're doing things to take care of themselves. So if you are a loved one that is providing care, or if that does come up, it is really important to make sure that you're taking time to take care of yourself mentally and physically as well. So I have one client that lived up in Seattle. She had to provide care for her husband for 2 years. He had a stroke. Her big thing is she painted. She had stopped painting for about 5 years to take care of her husband. I made sure she got back into painting with her daughter's help to ensure that she had an outlet and she was doing something, and she's still alive and thriving today. So by no means is it having a spouse die, I mean, you're going to die 3 years later, but that does happen a lot unless you are really, really committed to taking care of yourself as well.
I agree, Paul. And I think what I would say is in the absence of planning is it makes it easier for there to be friction, right? Because everybody's concept of how to respond to an unplanned event will be different. A lot of times the responsibility for care typically falls on the female members of our family. One of my team members that designed my Medicare, not to overshare her situation, but she, her mom lived in Boulder City. She lives in San Diego, and she had a brother in Seattle and a brother in Boston. And once mom needed care, everybody loved their mom, but, my team member Jen had to, help her mom sell the house in Boulder City, move her to San Diego, right, and kind of oversee her care, and and spent down a large portion of her mom's assets on care, and there I don't want to speak to how much friction there was, but the bottom line is in these events, the chances that if you have 3 kids, all 3 kids are doing a third of the responsibility is a statistical impossibility, right? It's never that. Additionally, there's that concept of, okay, well, who's who's the caregiver, right? Maybe it's a daughter, maybe it's I mean, spouses aren't going to collect money, but a kid sometimes is giving up their paid job to care for mom. And there's just so many opportunities for hurt feelings or a miscommunication. So it's so worthwhile to chat about it ahead of time, when you can, rather than put people in a position to respond to it. And then, there's other dynamics there. Like some people are happy to caregive for free, but then once mom passes away and they can sit and look back at what they did that the other siblings didn't do, there's no shortage of opportunities for hurt feelings or accusations or things like that. And I don't think that's what anybody wants. So the best way to address it is just talk about it ahead of time, right? I mean, self-insuring is an option. Insurance is an option. There's just a bunch of different ways to do it, but talking about it long before the event happens is just in every family's best interest.
Hey guys, just because we have awesome attendees that like to share some of their stories too. Somebody dropped one in the chat box to us. But if your loved one is already in a long-term care facility under Medicare and before they're released, you tell the facility that you've applied for Medicaid. It's very difficult for the facility to throw the patient out, apparently. They did this before Medicaid kicked in, and they were directed that this is honestly probably the best way to handle the situation as far as payment.
Yeah, assuming that there's no assets to pay. Yeah, that's great insight. So I think that kind of leans towards the concept of, if it's your first rodeo, it's really good to be around people that it's not their first rodeo, right? So obviously somebody very astute gave that person good advice, and so mom had assets. Yeah, so there's the asset limit. I think I don't know. I don't want to put you on a spot, Paul, but the asset limits have been raised in recent years. It might only be a year. I'm not totally savvy on Medicaid and Medi-Cal, but it used to be you had to be entirely broke. There might be some latitude to that now. I'm guessing, if I'm guessing, that event with your mother probably happened in the last 1 to 3 years.
Correct. Yeah, there's some planning that can be done ahead of time, some trust work and other things that can be done to kind of help navigate that if you're trying to get for Medicaid, for example.
Yeah.
I know there's a lot of questions here regarding specifically long-term care insurance, kind of how that works. So we're going to dive into that. When we talk about long-term care insurance, there's two basic forms of policies here. There's what's called traditional long-term care insurance. This is your traditional indemnity plan. This works very familiar to like auto insurance or homeowners insurance. If you pay for it, it's the cheapest form of coverage. If you need it, great, it's there. If you don't get anything ever for that money. So for long-term care planning, especially if you're doing a dual type of plan where you're going to kind of self-insure and potentially get some form of traditional coverage on long-term care, this is a common way that I begin to see that. But if you pay into this for 20 years and never end up using it, you don't see any benefit for that. So that's the upside to the traditional long-term care plan, is it's the cheapest form of insurance and it's there if you need it. The downside is you get nothing for your money if you don't use it. So it's kind of that traditional insurance product. What we've seen more recently, what would you say, about 15 years now, the hybrid policies? They've been around longer, but I at least from what I've seen, they've really been gaining popularity the last 10, 15 years. These are policies that are built on as either an annuity or a life insurance. The life insurance I tend to see more commonly, but it's a chassis of a life insurance or annuity, but then it provides long-term care coverage, and it's designed primarily for the long-term care coverage. If you don't use the benefits, then it can pay out a source of income or it can pay out a death benefit. So the money's coming back with some small interest to family members, so the money you paid into the policy isn't just completely lost. Anything you want to add there, Brian?
Yeah, that's great. I think Look, I think the entry point for most people would be traditional long-term care. As we look at these stats, it's nice to have a long-term care policy that covers 4 or 5, 6 years of benefits. But even a shorter long-term care policy, let's say a 2-year benefit, I would say short term is better than no term if you didn't buy long-term care insurance, right? So the entry point would typically be traditional long-term care insurance. Anybody that has any interest, that's probably where it'd start. And then from there, those conversations sometimes, if you've got a little bit more assets, those hybrid policies kind of come into play.
So
So there's a couple different ways to skin the cat.
what I'd like to do real quick here is here is just the median cost. Okay, so this is kind of the average based on what we would call a most likely scenario. So we're just taking statistical averages here, people. This can vary greatly depending on your health and the state that you live in. So that is my disclaimer for these prices. But you can see here based on the age and the cost for a male or a female, and this is on the basic long-term care. This is not the hybrid. This is pay as you go. If you need it, it's there. If you don't, you just paid into something and you never get the benefit for. Okay. But you want to see what the cost is based on kind of the age that you start. You can see that here. So you can see how starting at 50, it's only going to cost you 1,500. 60 goes up to about 2,100, but you're at greater risk of maybe not qualifying at 60 as you would at 50 or 55. So these are the type of things that you got to take into account when you're doing your planning for long-term care. Brian, I think
Yeah.
you go ahead and add. What do you have here?
No, I was just going to say that, yeah, and these are averages. I mean, that's probably not far off, but everybody's situation is a little bit different. So I'm going to say that these averages, they're probably good nationwide averages. It might even be a little bit high from what I've seen. So, which of course might be, welcome news. But yeah, I'd say this is kind of the starting point for traditional long-term care insurance.
Perfect. And I believe you actually got some quotes on some long-term care plans, hybrids. Can you kind of compare those versus these premiums here?
And quickly,
Uh,
are those monthly or annual? Because that's I think a quick question that
Oh,
could be
sorry,
answered.
these are annual.
Annual, yeah. Yeah, so it's a little bit of an apple and an orange to compare traditional long-term care to hybrids on the spot, but suffice to say, like on this screen, I think in most cases in California, a female would be less than $4,341. But let's just say, even if we're calling it, $2,600 to $3,000 a year per person, that would typically get you buy you $4,500 a month in long-term care benefits. Let's say for at least 2 years, right? And that's about the shortest I would do. And then if you can afford to do a 3-year benefit or 4-year benefit or 5-year benefit, obviously the premiums go up. But this is kind of a good starting point. And look, if you bought long-term care insurance with a 2-year benefit, would it be nice to have 4? Yeah. But even if you had a 4-year benefit, you got to go through the first 2 years, right? So, in order to get 2 years in a day. So again, any type of insurance is usually better than no type of insurance. And I think if we looked at what the average cost of care is on any given day in any given state, Paul, your monthly premium on these is probably equivalent to about the cost of a day of care. So you might pay, let's say, $250 a month for your long-term care policy. That one day, if you need long-term care, would reimburse you $250 a day for 2 years. So roughly the cost of a day of care is about the monthly premium in this example. So I guess I would just
Yeah,
add that
and I
in.
want to touch on something you said there, Brian. Back to where I said a lot of clients will kind of do a combination of planning. Um, they may take a couple different avenues here where they may use savings. Maybe they have friends or family take care of them, and they have a small long-term care policy to kind of help if they need something that's not in-home care or becomes too expensive, just keeping the person in the home by themselves. So you can have a layering effect. With these long-term
Right.
care policies, you can buy that benefit. So think of these a little bit like life insurance, right? When you buy a term life insurance policy, 10, 15, 20, 30 years, you choose how long you have that coverage. With these long-term care products, it's the same thing. So when Brian's talking about a 2 year or 5 year, that is how long do you want those benefits to be paid out on that insurance policy? Do you want it to be paid up to 5 years, 7 years, 2 years? That is something to keep in mind when you're buying these. So that will obviously impact the cost. The longer the time period, the higher the premiums, of course. Now with that planning though, the average stay is around 3.5 to 4 years in long-term care. Is that still right, Brian?
Yeah, I think about that. That's probably the average. The physical impairments are usually, 2.5 to 3.5 year events. Cognitive impairments run about 8 years, right? So the average probably lies somewhere in the middle.
So, and this is just important to know when you're doing this planning. Again, it's just how much risk do you want to kind of take on for you or for a family member. So knowing the length of potential time is a good way of planning. If your family has a history of dementia and Alzheimer's, that average is 7 to 8 years. You may want that 5 year policy instead of the 2 year policy. Things like that are important considerations as well.
Yeah, but I mean, look, if you can't afford the 6 year policy, then I would just also point out, even with a long-term care policy that will cover the first 2 years of the event, even if we knew your event was going to go more than 2 years, which of course nobody knows, but let's just say we knew that, you and your family are still going to trigger those benefits the moment that you're eligible, right? Because you paid into it. You would never wreck your car and not file a collision claim. And it also gives your family kind of 2 years of an unrushed experience to decide, hey, what are we going to do for care if this lasts beyond 2 years? So, yeah, so some of it's affordability, some of it's benefits. I think some of it is just not having to react without resources. So
Yeah.
again, short-term care is still better than a no-term care policy if you don't have long-term care policy.
I would agree. Yeah, there's a lot of different ways that it can be funded. So doing planning with a financial planner can be very beneficial to help kind of piece together. Because like I said, for most people, it's not, oh, I have this money in my IRA or I have this. It's typically a combination of different assets. Maybe there's a second home that should be sold to help fund it if needed. Things like that are always things that should be considered in the analysis. Brian, is there anything else you want to add before we head to questions?
No, I think just having the conversation before the event happens is really, regard. I can't stress that enough, and I also don't want to be repetitive because I've said that a couple times. So I think that's what this slide does.
All right,
Cool.
Chad, back to you for some questions.
Thanks, gentlemen. So as I mentioned earlier, all the contact information is up on the page if you want to touch base with Paul, or touch base with Brian if you have follow-up questions, or scan a QR code to get in touch with us, and we can reach back out with a scheduling link. I did just post in the chat box a link to the PDF slides from today's presentation, as well as a link to a 1 to 2 minute survey. Again, this is the result of multiple surveys over the years, and we like to bring you all content that you're asking us for. As we get new ideas from everybody, we try to put together custom presentations that we could bring to you. Okay, so if I get to the question with the most upvotes right now, and I think you answered part of this. The first half is like, at what age should I be thinking about like looking at this? For somebody, between 50, 55, 65, really depends on your situation. What's the easiest way? And I know this is going to be, it depends, but any general ideas for someone to determine how much coverage they need?
How much coverage they need. It's really the easiest way to answer that is with a financial plan. Because a financial plan is able to project out how much assets you're going to have over time, what the projected costs are going to be depending on the level of care. Are we talking about a skilled nursing, staying in the home with 24/7 care? So there's a lot of variables to try and answer that. I would say talk with someone that sells it, or start with a financial planner first, kind of dig into what your goals are. Let a professional know what you're trying to accomplish, what your family history is like, how much risk you're willing to take. And then with that information, a plan can be put together.
Yeah, I agree. There's certain risks in the financial plan that, like Paul and his team could help you mitigate the risk of entirely, right? Medicare is pretty exhaustive. Like once you have Medicare, there's not you really don't get a lot of huge bills regardless of what you do. There's trade-offs between options. Long-term care, I don't know if you agree with this, Paul, but in general, I would say I wouldn't. You definitely have the pressure to cover 100% of the risk that a financial plan would dictate that this is how much long-term care is going to cost in your area at this age. Do I think you need to put the pressure on yourself to have insurance cover 100% of that? No. I'm going to say in most cases, I don't know what you think about this, Paul, but I say usually if insurance feels like a good option for you, if you could mitigate, 50, maybe 60, maybe up to 65% of the risk, I would call that a win. I think in all, for most people are self-insuring by default because they haven't really thought about this topic, or they're self-insuring reluctantly because maybe the risk is so big relative to the assets that they have. They just go, I don't even, know how I could plan for this. But in reality, and I think if your care cost $8,000 a month and you had insurance that covered $4,000 or $5,000 a month, and you were going to self-insure the other, $3,000 a month, I think that's going to be palatable to a lot of households. So, I wouldn't feel like if you can't cover 100% of the risk through insurance that's
No, yeah,
a
often
bad thing.
you're trying to get 100% of insurance, you can do so, but you're probably paying more than you need to into the policy because truly you don't know if you're going to even need the coverage to begin with, right? We won't know until we get there. Hindsight's 2020. So I do agree with you, Brian. Typically trying to insure about 30 to 60% is typically what I've seen with my clients over the years, where we're trying to cover a good chunk of it, but typically there's still some form of self-insurance there. Unless there's significant assets and there's no loved ones, then typically we'll look at higher, like 80 to 100%, to make sure that their needs are taken if they don't have family members that they can really rely on.
I agree.
Cool. Okay, so next question I have is, as a younger adult with no spouse or children, at what age would be appropriate to get long-term care insurance for myself? I think this person asks it because their parent got it at age 35 because they're the only child with no spouse. Do you guys see people do that at relatively young age?
Um, I have not, I've been doing this 20 years. I have not seen anybody buy a policy below 50, except for one time, and that was because some physical things that had happened to him in the future that we were concerned about his insurability and I'm concerned about his lifespan. So we did around 48. But that's the youngest that I've seen.
Yeah, most long-term care insurance companies won't even. I think you'd be hard pressed to find any that'll issue prior to 45, and 50 is even the minimum on a lot of them. So, um, there's a lot of risk the insurance companies take, and the cognitive impairments actually are the most expensive because oftentimes those events last for a long time, and
Need the highest level of care.
yeah, so I think there's probably not as much willingness to, issue policies below 45 or 50, um, because there's a good amount of risk the insurance companies are taking. These are expensive events when they happen.
Yeah, and just in terms of the pricing history with long-term care, when these policies were first issued, they were actually actuaries were wrong. They were projecting lifespans shorter than what they really were, making the policies more cost effective. So if you got a policy when these first came out, they were pretty cheap and gave you great benefits. Over time, the insurance companies caught on to this, and they swung the pendulum from being too cost effective to being too expensive with too little benefits. In recent years, I'd say the last 3 to 5 years, I've been seeing that pendulum kind of swing back. Would you agree with that, Brian?
Yeah, I think that the entire industry kind of mispriced the risk for a good while, and as a result, they were not collecting enough premiums. Again, the biggest opportunity for the misprice and risk was the cognitive impairments. So suddenly, so with traditional long term care, again, just like homeowners insurance, just like auto insurance, it was they can always apply for rate increases, right? So if you had a traditional long-term care policy that you've had for like 20 or 25 years, you may have seen every couple of years they apply for a rate increase, and those rate increases sometimes are big. You know, you could have been paying $3,000 a year, and you got a letter that said, "Hey, if you want to keep the same benefits, you got to pay $4,500 a year." Or you keep paying 3,000 and reduce your benefits. Nobody was happy with that situation. So that was like the big disruption. And as a result, the whole industry started correcting quite a while ago. So traditional long-term care insurance, which again is the easiest place to start, though they can have rate increases over time. The gigantic rate increases those days seem to be largely over. But that was a thing for a while, and worth knowing about. And then the hybrid policies, which is usually more that you're putting in, instead of paying $3,000 or $4,000 a year for the rest of your life in a traditional policy, a hybrid policy, you might put in 10,000 a year for 10 years. So like a finite payment schedule, but the rates cannot increase. The insurance company will never ask you for more money. If you die and you don't need long-term care, your family gets your assets back, that sort of thing. So traditional long-term care has some ability to increase those rates over time. I haven't seen it be nearly as ugly as it once was. Hybrid policies, which is a little bit more of a finite investment, those rates cannot change.
I'm seeing a lot of questions here just kind of on the structure and how long-term care policies actually work.
Yep.
So Ryan, why don't we take a second and just kind of walk through, let's start with the indemnity policy, the traditional long-term care, kind of discuss
Maybe.
how that works, how those policies pay out.
And also include the difference between long-term care and long-term disability, because we got several upvotes for that too.
Okay. Well, I'll probably say disability is basically very similar, but it's covering you during the years that you can no longer earn income. So most disability policies actually are not too different from long-term care policies, but pretty much every disability policy on earth would only pay you claims up until age 67, right? So long-term care is, while the functions of the policy might be pretty similar, long-term care, you're typically not going to trigger that claim till age 80. So a long-term care disability policy, in most cases, would be valueless at age 67, which is well before long-term care events.
Disability is designed to give you a paycheck if you can't work. It's designed to insure against loss of income. Long-term care is designed to cover the costs of additional care needed due to physical limitations. So similar in kind of concept, but they insure different events.
Yeah, well said. So let's start with traditional long-term care. We'll just keep some easy numbers. Let's just say that you were looking to buy, and I'll use an entry point policy, right? You can certainly get more robust than this, but let's just say you were looking at a traditional long-term care policy to pay you or reimburse you $150 a day for your care received in a facility or at home, right? So $150 a day is about $4,500 a month for 24 months. That would pretty much be the shortest long-term care policy you would buy. So how would that work? Let's just say in general, that would probably run most people about $250 a month for the premium, right? So you're applying I'm just using age 65. So age 65, you apply for long-term care. You say, okay, I want $4,500 a month of a benefit that'll cover me for the first 2 years of my long-term care event, right? Paul or Chad could do the math on 4,500 times 24 months, but that would be your, let's say, maximum benefit available to you as quickly as $4,500 a month. So suddenly you buy that insurance, and a couple of years later you have some, physical limitations, and you or your loved ones realize that, hey, whatever those 2 out of 6 activities of daily living are, let's kind of dig through that, because there's quite a few things mom can't do anymore, right? So typically what would happen is your loved ones would bring you to your doctor. It used to be the insurance company's doctor. It's almost always your doctor now, which I think is better. And your doctor basically signs off on the long-term care insurance claim form and says, hey, Judy cannot perform these two activities of daily living. The insurance companies don't really care why you can't do it. They care that someone with MD at the end of their name says you cannot do it. And then they basically prescribe care. And they would say, here's the 2 out of 6 activities Judy can't do. And she needs to have licensed but unskilled care in her home, right? So at that point, whatever the doctor prescribes, and the doctor could always adjust that prescription, then you go out and you hire licensed, unskilled care in your home. And, I'm just going to burst everybody's bubble. I think if you're listening to this from California, you're probably not going to get home care for only $150 a day, which is what the insurance pays, but maybe it runs you $250 a day. So you hire care any and all days for $250, and for every day you've received care in your home, according to the doctor's prescription, the insurance company, you just send them the bills at the end of the month, and they're going to say, oh, well, you received 30 days of care in your home. We owe you $4,500. Now, maybe your care cost, it's 250.
Yeah, I mean, just taking averages here, Brian, if we're looking at California at $35 an hour for an 8-hour of care per day, that's $280 per day that's being spent.
Yeah. Yeah. So, in this example, let's just say the insurance reimburses $150 a day. You can totally get one that reimburses $200 a day or $288 a day, right? But every day you receive care in your home, the insurance company in this example owes you $150. And, if you're only getting care in your home 5 days a week, well, then you've only burned through, 5 days of the 2-year benefit, right? So that would be the way a traditional long-term care policy costs. Let's just say that costs you $250 a month. If you die and never need the care, there's no death benefit. Again, that's, you don't complain if your house or if you don't wreck your car, right? So it's just the cost of insuring that risk. Those premiums can creep up over time. Again, they used to be really abhorrent. That tends to not be the case right now. But that would be kind of an entry point traditional long-term care policy. So, and of course, if you want a 3-year benefit or a 4-year benefit or more than $150 a day, the price just goes up correspondingly. So that's an option that's pretty much available to anybody, right? That would be the entry point of long-term of planning for long-term care. The two alternatives of a traditional long-term care policy are, one, self-insuring, which is you just say, hey, I'm going to pay for this out of my pocket, or I'm going to lean heavily on my loved ones to do that. And I wouldn't villainize that as long as that's like, a real that you can afford that and that the family members who you think are going to take care of you know about that. But typically, what the alternative to traditional long-term care is what we call these hybrid policies. Typically, people with a little bit more assets do this. I'm just going to give you an easy example to keep it simple. And if I do a good job delivering that simple option, then I'll layer some things on top of it. So the way that these hybrid policies got popular were in single lump sum premiums. Now, you can pay these over time now, but just indulge me. Let's just say somebody was concerned about long-term care. The question we usually ask people is, hey, if you needed care tomorrow, what asset would you liquidate first, right? It's not going to be your best performing mutual funds, hopefully. It's not going to be your primary residence, hopefully. It's going to be usually the safer part of your portfolio. If it's not cash or savings, it's going to be something that feels like that. That's what anybody, as long as you have cash or savings, would liquidate first. And after you liquidate your most conservative asset in your portfolio, you're going to go to your more moderate asset, and then your, probably riskiest asset. But again, in self-insuring, you're probably depleting those parts of your portfolio pretty rapidly because these events are expensive. So what's the alternative? Let's just say somebody said, well, here's the first $100,000 I would spend on my care if I needed it tomorrow. So with the hybrid long-term care policies, basically the concept is, well, let's, consider looking at the first $100,000 that you've pointed out that this is what you would spend down first. And you could park it into an insurance policy. And that insurance policy would typically provide a good amount of leverage. So let's just say it's $100,000. You park it in one of these policies. Maybe that policy gives you a $300,000 long-term care benefit. Could be even more, but let's just say it's $300,000. So day one, you put $100,000 sitting in this policy. Your long-term care benefit is $300,000. So you just leveraged the safest part of your portfolio threefold in the event that you need long-term care. And that $300,000 might be accessible at, I don't know, $60,000 a year in benefits reimbursed to you over 5 years, something like that. So your $100,000 that would just get you $100,000 of care if you self-insured would get you $300,000 of care over, let's just say, 5 years if a policy like this made sense. What happens if you don't need care? You could, prudently plan for a long-term care event and live till 117 and pass away in your sleep and go to as many high school football games as you like. And maybe you didn't need care. What's unique about these hybrid policies is that they do have a death benefit. The death benefit's not there to make you wealthy or make your family wealthy. It's typically there to give your family the money back that you prudently set aside for long-term care and didn't need. So you might take your $100,000, put it in one of these policies, and maybe the long-term care benefit is $300,000. If you die and never needed a nickel of care, your family gets back about usually no less than $100,000. The death benefit doesn't really grow, but it's just returning your money to your family because you didn't need it. And then number three, some of these policies have some varying amounts of liquidity. They might, if you change your mind, they might give you back 70% of your money or 80%. They used to do 100%, but the market's kind of tightened since then. Nobody really liquidates these things, but sometimes they're more comfortable allocating some portion of their portfolio into these because in a worst case scenario, they could get 70 or 80% back. Typically, most people who go this route pass away and never need long-term care and their family gets the money back, or they need long-term care and they leverage their safest asset up, threefold or more. The other thing I'd point out before I finish explaining this is the rates and premiums cannot change on hybrid long-term care. So there's no circumstances that exist where the insurance company would call you 5 or 6 years later and say, hey, in order to keep these benefits, you need to send us more money. Where traditional long-term care, the entry point, that can happen, just like your homeowner's insurance creeps up and your car insurance creeps up. But that's kind of the way those two work and what, some similarities and differences are. I could go on, but let me be quiet and let you guys chime in with some other questions.
So, with everything you just said there, a few questions that are still kind of lingering. Some people want to know what it takes to pre-qualify for these policies, or maybe another way of saying that is what type of things would disqualify them from qualifying for sorry about that, from getting long-term care. The other component to that is, can you just talk about the basics on the policy, if there's any elimination provisions or anything like that people should be considering if they are thinking about trying to get one of these policies?
Yeah, great questions. Let's address them in the order that you asked them. So, in general, if you're hearing this and you think, oh, well, I've got this ailment or that ailment, and of course, the more ailments, the more concerned you are about getting approved for insurance. Long-term care, you definitely have to go through underwriting and fill out the application, and they can choose who to insure, who not to insure. One of the things I would point out is virtually everybody has applied for life insurance, right? So that's kind of our baseline benchmark in our head. And look, the healthier you are, the easier it is to get approved, right? But as far as what's long-term care underwriting looking at versus life insurance, like life insurance is looking at things that kill you quickly, right? Long-term care underwriters are looking at stuff that does not kill you quickly, maybe kills you slowly, or is not going to kill you. Their risk is to figure out, are you a good risk for them? Because if they wind up on the losing end of it, you are going to need a long-term non-revenue generating employee to take care of you, right? So they're really looking at the activities of daily living. So if you had a heart attack 20 years ago and you're healthy, like I'm not saying that's going to help you get approved for long-term care. It probably will not hurt you, right? Um, thanks, Chad. But you know, if you are on, pain meds, right, or um, need knee surgery or um, anything that affects your ability that increases your risk to be unable to feed yourself, bathe yourself, dress yourself, transfer yourself, toilet incontinence, right? That's what they're looking at. And also they want to make sure you don't have a severe cognitive impairment today. So in general, I'd say if you're anything more than absolutely not interested in talking about long-term care insurance, if you think of your health history, like, they don't like pain meds, right? They don't like things that look like there's an increased chance that you cannot perform those activities of daily living. So that's kind of the way I would think of that. There
Yeah,
are,
I'd say it this way. If you are average health in general, you should be fine unless there's some underlying event that is kind of unique that or not commonplace. But if you're, average health or, even slightly below average health, you should be fine qualifying for most of the policies.
Yeah. So and you don't know until you know, right? So
Yeah.
typically you fill out these we have pre-qualification forms. So typically I would have people take a look at that and just say, look, lie to your mama, don't lie to me. I'm on your side. Like, take a look through this. Is there anything we need to be concerned about? Because there are these like knockout conditions where if you have to answer yes to a couple different things, I might say, okay, we shouldn't even bother to apply, right? But if you don't say yes to any of them, then typically we go, okay, it's worth going through. And I don't like putting people to the effort of applying for things that I don't think they'll qualify for. But if you don't say yes to any of the pre-qualifications, then I say, well, let's go through the process and see if you get approved. And then you kind of go from there. There's also like lists of medications that they say, hey, if they're on these medications, don't bother to apply. But again, most of those are going to be for severe illnesses you already have, or again, pain meds. The pain meds that you're not going to ever get off. They're probably not going to like that. The other question that I'm sorry. So that was pre-qualification, and then what was the second question, Paul?
Second question is for somebody looking at a policy here, what are things that they should be looking for to get the policy? Should they be considering things like elimination periods, insurance company ratings, just general tips that you would give someone looking for this policy to help them choose the right one?
Yeah. So insurance ratings absolutely matter. Most companies in this space are probably going to be A-rated or better. So while I would never trivialize credit ratings, but I'd say there's not nearly as many companies offering long-term care insurance that there was maybe 25 years ago, because again, a lot of insurance companies kind of lost their appetite or mispriced it or something like that. So the ones that are around are actually very, very stable, but they're pretty much virtually all A-rated or better. Elimination period is kind of like, okay, my doctor signed off that I cannot perform 2 out of 6 activities of daily living. He says I need home, licensed skilled care in my home. You're going to go out and get that care. An elimination period says was the insurance. It's kind of like a deductible measured in time. The insurance company goes, "Hey, you're eligible for care, but we're not paying your first 30 days of care, or we're not paying your first 90 days of care." Right? So you can adjust those. You can say, I want 0-day elimination. Well, the insurance companies will do that, but the monthly premium will be a little bit higher. And if you're okay with a 30 or 60 or 90-day elimination period, then it's a little bit lower. Of course, nobody likes paying premiums and then not getting the benefit. So when possible, I'd say most people lean towards as low or no elimination period if it can be managed. The hybrid policies mostly are all 0-day elimination period. Traditional long-term care can be 0, 30, 60, 90. And we just kind of play around with, when you kind of design the policy of, what seems palatable. And if you're buying traditional long-term care insurance and you go, look, if we needed care, I've always been a good saver, and I never don't have 20 or 30 or $40,000 pretty liquid. Well, then maybe you can stomach a 30 or 60-day or 90-day elimination period. And you just say, okay, well, I'm just, if I go 90 days or beyond, then that's when the insurance will kick in. Some people just want to get in the insurance company's pockets quickly, right? You don't want to wait. And for those people, you might prioritize a, 0 or 30-day elimination period.
Well, so just because we're at the bottom of the hour, before I ask you the next question, I just want to make sure there's like 6 of them left, at least at this moment in time. Do you have a couple of minutes left?
I do, yeah.
Well,
Yes.
I mean, for everybody else, I know we build these things for 90 minutes and usually get a ton of questions to extend these things between a 45 to 60-minute presentation. So if you do need to drop, thank you all for attending. We hope you enjoyed the session. But I do see at least a few of these questions that did not ask anonymous. They are still on the line, so I want to make sure we address them. I think the first one that has a thumbs up with it too is, if I apply for care as soon as I notice an issue, what happens when I run out of benefits?
So let's say you apply for that minimum policy to cover the first 2 years of coverage, and then an event happens. They're paying on it, and your event lasts 3.5 years. The first 2 years, the long-term care insurance policy will pay out, but for the remaining 1.5 years beyond that, so starting month 25, your policy is done. It's paid its benefits.
Right.
There's no more benefits there. From months 25 on, you have to self-insure. You have to find a way to pay for those costs at that point.
So the next one I have is, I have long-term care insurance through my work. With all my other monthly expenses, and I'm in a dual income with my spouse's income, I selected the lowest premium. Would that even be enough? Or should the goal be to select the highest premium?
I would say this is most likely confusion, because we talked about it earlier. This is most likely a long-term disability policy that the employer offers. I have not seen long-term care insurance offered through an employer. I'm not saying it doesn't exist, just saying I haven't seen it. So it's far more likely this is the long-term disability that we talked about earlier, where it's designed to insure against loss of income until most commonly age 65 or age 67. So if you and a spouse are both working, one of you gets hit by a drunk driver and can no longer return to work, the long-term disability would step in and cover up to 60% of their income, so that you're still receiving, so that way you can still maintain the same standard of living, hopefully, despite the accident. So to discuss more on that, feel free to reach out to me. I'm happy to take a look and answer that question more offline.
And I did see Brian do that. Yeah, kind of. So it sounds like something like he's definitely seen employers that offer it. It seems like it's rare. So it could be.
Yeah, I would say statistically there's a good chance it's long-term disability, but there are not a lot, but there are some group long-term care employer-sponsored options. And I would say, I don't want to shoot from the hip because it's better to go through a full planning process. But if you have some sort of long-term care, like a true long-term care benefit,
sounds like this person does, by the way, too, through Unum.
Okay, yeah, that's okay. Unum is one of the few carriers that do it. So yeah, in general, I would tell you, if you ever stop working there, typically they're portable, which means, hey, you can take this with you. Maybe right now your employer is paying some portion of the monthly premium, and they say, hey, you can keep it, but you have to pay the full monthly premium, right? In general, is that enough care or not? Paul and his team are probably better off to help you figure that out. However, I think the chances that you would cancel that in order to buy more long-term care, I think, are de minimis. The chances that you might keep it, and if it turned out that you needed more coverage and were unable to get that by increasing the coverage to your employer, then maybe you buy a long-term care policy on top of that. But if you have something in place, it's very rare that we just say, hey, get rid of that and go buy this. It's basically like either we just tell you to be grateful for what you have, because it's enough. And if it's not enough, can you increase it at your employer? Honestly, if you can, that's often an easy thing to do. If you can't increase it and there's enough of a risk worth mitigating, then maybe you add your own policy on top of that. But yeah, Unum is one of the few carriers it's not a common benefit, but I've seen it on occasion, and Unum pops up when it does exist.
Cool. So the next one is, what musts or minimums should a long-term care policy have? Like accreditation, like anything else that like you kind of think somebody should require?
So, the credit ratings are largely mitigated because there's just not a lot of, low B and C rated credit rating carriers that are even in this business. So, high credit rating. A history of paying claims is kind of good. I know Lincoln, as an example, has now been paying claims for like 35 years. So it's one thing to sell the insurance; it's another thing to actually pay the claims. Because like, look, a life insurance claim is, you fill out a claim form because your loved one passed away. You send in a death certificate. They send you $500,000 or $1 million, right? There's no ongoing responsibility. It's pretty difficult for a life insurance company or claims department to goof that up. Long-term care, I mean, these are kind of monthly claims and reimbursements. So, I'd say, well, when I say most of them are good, sometimes people say, well, who's the best insurance company, Brian? And I go, the best, they're all inherently evil. So let's talk about who's least evil, right? And, people chuckle. But there are, I don't know that there's any companies that are having big issues paying claims. But, if all other things were equal, I might lean towards an insurance company that's got a multi-year history of paying long-term care claims. Versus one that, is selling a lot of long-term care insurance, but they haven't paid a lot of claims. So, those are little things that we can, offer guidance on.
Cool. Next one is, with a hybrid policy, we've talked about a lot. If you use any of it, does it eliminate the death benefit?
Good question. So go ahead, Paul.
Short answer here is yes. The death benefit is essentially unused premium that gets paid back, is what the death benefit is designed to be. It's not designed to be an actual life insurance policy. So as you use that benefit, that's going to chew down and eventually eliminate the death benefit completely if you use up the full policy benefit.
Yeah, and to elaborate with an example, let's just say it's $100,000 premium that you put in, either lump sum or 10,000 for 10 years, whatever. You put in $100,000, and let's just say your death benefit is 100,000. Your long-term care benefit might be 300,000, and you do trigger long-term care claim. You go on claim, and let's say you get $30,000 in reimbursement before you pass away. Your death benefit would be 100,000 minus 30. Your family still gets 70. So, but of course, if you ever took more than $100,000 of long-term care benefits, because maybe your long-term care benefit's 300, so the first $100,000 in care would ultimately reduce your death benefit down to zero. But if you took $99,000 in long-term care benefits and then you passed away, your family would, get $1,000.
Okay,
So you or your family is getting value out of that premium, regardless of whether you died, were on long-term care, or some combination of both.
So I'm going to pull the next one from the chat box, especially because it's an intriguing one with all the genetic testing that people are doing these days. This person asked if they've done genetic testing, they have the gene for Alzheimer's. Is this something that the insurance providers can discriminate against? I mean, this person specifically is in California and recalls, California passing a rule against that. Is there anything that other states have not done, or?
Just a general rule of thumb here. You don't ever want to disclose more on an application than what's being asked. That applies for a home mortgage. That applies for life insurance. That applies for long-term care. If they don't ask, you don't disclose.
And I don't think they can ask you for the results of your genetic testing.
Yeah.
They don't have access to 23andMe or any of that kind of weird stuff.
I mean, Brian, maybe you can speak because you're more current on this than I am, but I have not seen a long-term care company or any insurance company for any type of insurance get into genetic testing yet.
Right. So the way this works, and you guys had a good point about not over disclosing. So when you apply for long-term care insurance, again, there's this pre-qualification form what we go through to make sure it's worth moving forward, right? And then you answer your health questions. It's not as thorough underwriting as life insurance because candidly, long-term care insurance companies want to know the answers to the questions they want to know the answer to. But you're also giving them access to any medications you've ever been prescribed, and it's kind of like with the smoke, there's fire. They can see what meds you're on, and if they know what those meds are usually treating, and then a lot of times that's what they're going to base their decision on the physical side. Cognitively, you submit the application, they process it, and as long as it looks good, then they call you for a cognitive test. It usually takes about 30 minutes, and you get this nurse that calls you that asks you a bunch of questions that if I rattle them off to you now, you would laugh at how silly they are, but that's because you do not currently have a cognitive impairment. But it could be something like, name 10 animals in a zoo, right? And you name 10 animals in a zoo. And I don't know exactly, but let's say 23 minutes later, they say, hey, and you're not allowed to write anything down. If they suspect that you did, then they don't, they shut the application down. But then like 23 minutes later, they'll say, okay, what are those 10 animals? And nobody can remember all 10, right? So there's some sort of range that if you remembered 8 out of 10, they go, okay, that's normal, right? If you remembered 5 out of 10, they would be concerned that you have a cognitive impairment, right? So with stuff like that, I always say answer truthfully, don't over disclose, right? Answer directly, don't use a lot of fluffy adjectives. And when you do that phone call, don't make jokes, right? I mean, we've had people make jokes and then they get declined, right? Despite us telling them, don't make jokes, just answer succinctly. They know what they're looking for. It's kind of, I think it's called like the Minnesota cognitive test or something like that. But none of that, all of that is measuring whether you have a cognitive impairment today. So that's what the underwriting is based on. So I wouldn't worry about genetic markers for Alzheimer's and dementia. I think to Chad's point, I don't even think they're allowed to ask you that. But I know that the cognitive portion of underwriting is really just based on how you answer that interview. And they just tell you, don't be distracted, make sure it's quiet in the house, don't write anything down. Because again, if you got 10 out of 10 on that, no human being on earth can ever remember all 10 animals in the zoo. And then that falls outside and they go, okay, well, this person must have written it down. And then they decline you, right? So you just succinctly, honestly, don't overshare and you just stay focused for it. And, people usually at the end of it chuckle and go, that was kind of interesting and weird at the same time. But that's what they're looking at on the cognitive underwriting.
Almost done. I think the next one should be easy. Can you use 401k assets to pay for a hybrid long-term care policy?
Technically, yes, but you're triggering taxes. So if you take the money out of, you'd have to, number one, take the money out of the 401k, which creates a taxable event, potentially, especially if it's a tax deferred. And then you're going to be using that money to pay for the policy. So yes, but that is not ideal. Talk with a professional if that's something you're considering.
Yeah, I'd agree. If all of your liquid assets are in your 401k and you want to plan for it, then you're probably not going to want to pull $100,000 out of your IRA in one shot. But again, the hybrid policies, you can, maybe do 10,000 a year for 10 years. And, there's not a whole lot of trade-offs to paying it over time. There's a little bit, but it's pretty palatable. And then, of course, you're spreading the tax liability of that $100,000 over 10 years, which is usually way more palatable and keeps you from jumping into higher tax brackets. So I agree.
Yep. Next one is, can adults purchase the long-term care policy for their parents? And are there age restrictions if the parents are already retired?
Yes.
Good, Brian.
The answer is yes, but
I would say it this way.
it's difficult. Yeah, I mean, the older your parents are, the better a chance they may not qualify. But go ahead, Paul.
Yeah, I mean, technically you could buy it for your parents. What I haven't seen that in the past. What I have seen is the kids paying the premiums for the policy so that they didn't have to pay for the care later on. But the parent still owning the policy is typically what I have seen.
Yeah, I've seen it kind of both ways. In the interest of time, I think most of your BFSG clients are in California, maybe not all of them. California doesn't have, there's a lot of things that they don't have. There are short-term care policies that, like I'm contemplating buying one on my mother-in-law in Arizona that is not as robust, but it's better than no insurance. Not available in California. But yeah, I mean, if you're if the person asking that question is 40 and mom or dad are 65 or 70, yeah, maybe. But again, the older you get, the more expensive it is. And in general, the more time on this earth, the better a chance that you've got some physical impairment that makes underwriting more difficult. So I'd say a cautious maybe. And we'd probably, Paul or I or both of us would probably want to know a little bit more about the situation to see if it's worth considering. Now, the flip side, is if you can't get long-term care insurance for your parents, you might be in a situation where you're self-insuring, but you maybe from an intergenerational family planning thing, you go, okay, well, we may not like self-insuring on mom's long-term care, but we can do it or we have to do it. We probably don't want to do that through two generations. So maybe it's like if you can't get mom insured, maybe it's good to look at long-term care insurance for you and your spouse, just so that intergenerationally, the family assets are going to absorb one self-insuring event and not two or three. I don't know, just a thought.
Cool. So last one we have, and this goes back to you talked about credit rating, maybe not being the biggest risk, but this person has a policy they've had for 20 years, so long policy too, with Genworth. That seems like it's going to double in price over the next few years, and they do have a poor rating. Any thoughts?
Yeah, I'll tell you, I'd I know I need to come up with a better metaphor. Sometimes but I'll use the one on my mind for better or for worse. But I hate to like slap some lipstick on the pig and call it pretty, but honestly, if you already have a Genworth policy in place, even with their ability to increase premiums, which they do on occasion, if you looked at what it would cost to duplicate that type of insurance today, you'd probably be kind of grateful for what you have. So
Might be worth
again,
getting a quote just to compare and know.
yeah, there's no harm in doing that. I guess um, I'm usually hesitant to tell people to cancel those things. Now, there's a couple different things you could do. There's one, you could just stomach the increases, right? And every couple of years you go, this is the way it is, right? If you've owned that Genworth for a while, you've probably gotten increases, and again, they're kind of clunky. Like you don't hear anything for 6 years, and then 6 years later they go, hey, your premium's going up 50%, right? So you can stomach that, but which there might be a case for doing, although it doesn't make you feel great. Or they say you can keep your same monthly premiums, but we have to lower your benefits now, which is kind of like stripping the hubcaps off your car and that sort of thing. But if we took a look at that and figured out what it covered, what it doesn't, what you're willing to tolerate in premium increases, if the coverage isn't enough, maybe you keep the Genworth. Either you keep the Genworth and just kind of grin and bear it, or maybe you keep it there and you go, I'm going to keep Genworth, but I don't want to keep paying the higher premiums. I'll just let them reduce my benefits a bit, but I don't want to get rid of it. And then, maybe you marry that with a smaller hybrid policy, or just something that just says, well, rather than during the higher premiums, I'll just put that towards a hybrid policy where it can't change. It can't change. I don't know. I guess there's a couple different things to do it, but usually I kind of tell people there's a good chance that I'd tell you to be grateful for what you have, and then evaluate, like if it's not enough or you just don't like the premium increases. Maybe there's some things to do, but usually the answer. It's rare that I just say cancel Genworth and let's go buy this, and it's my answer is usually not that.
Awesome. Gentlemen, that's the last question we have. Paul, can you put it on disclosure just so compliance doesn't get upset with us? You can bring it back to the contact page right after you put that up, but at least they need to see the disclosure in here. Again, thank you everybody for joining us today. Reminder that the survey will go out via email too. A replay link will go out. The link to the PDF slides will go out tomorrow from our team. You will get 2 emails, one from Zoom with the replay link that goes out automatically, and then one from our team as well that includes a few extra resources for you all. Thank you for staying on. I know it is long by the time we get done with this, but I think one of the things most of our attendees appreciate the most is getting through the questions at the very end, regardless of how good the content was at the beginning of it. Brian, Paul, any closing remarks for the group?
Thank you for everybody for staying with us on such a boring topic for almost 2 hours.
Yeah, I agree.
It's cybersecurity next week. I think that's even more boring, everybody. Yeah. Cool. Thank you, guys. Thank you, gentlemen.
Thank you.
Thank you.